Okay, so just gone 4:30 in London, European cash close, having a quick review of the day. And a few things to have a look at. For one, equity markets in the US remaining in positive territory, so a little bit of a bounce back from the two-day performance that we've had. Again, it's been several months since we've last had a consecutive kind of down days in the US equity market. So looking at the S&P here, a couple of key levels that we had been looking at a slightly longer dated chart, and one of the questions I'd had was, what type of pullback do we need to see in the US equity market to start to change people's minds that actually this could be something more behind it in terms of the recent downside that we've seen. This does of course come in the month of January, which as a total move, we've gone basically the best part of 7.5%. It is in fact, I believe, the best January of any year on record. So we've had a phenomenal rise through 2018. Obviously Trump, a big part to do with that. The agreement at the end of last year about the whole corporate tax issue, him then pushing on with further policies to implement going forward, has meant that equities have continued to surge to these record-breaking levels. Now, on the pullback, question mark then is where is interesting to, if you are a believer of buying the dip, then where could those opportunities arise, or where would be a meaningful level of support that if broken could open up some further downside? And so just looking at a chart here that I was looking at earlier this afternoon, and really it's this price point where we found a degree of resistance around mid-month, and then we eventually broke that on the 22nd, but we've had a bit of a pullback, close proximity to it, but it's really that zone that I think is very key technically on any move to the downside if that were to occur in the S&P going forward. Obviously, as we can see on today, we have rebounded off of that and we're currently still in positive territory. Beyond that point, if we were to break lower, the next kind of two areas of significance would be down here at 2760. That was that previous, again, point of resistance on the 9th and the eventual really strong break that we had. And then below there, you've got the December kind of second half of deck consolidation of 2017, which would be the area down here. Now, one of the things, I guess, from the current price level down to that lower level, I'm trying to think what type of situation would need to occur to push the equity market 5% down. There's not a great deal of scenarios I think I can throw your way short term where I could really foresee that happening. Because the one thing is, if we were to get a dramatic fall in the equity market to the downside, as we know, the central bank will just step in, tweak the communication and the telegraphing of their kind of forward-looking policy to be ever more gradual and cautious, and hence this kind of runaway of hawkishness might be dissipated, and that will help support any violent fall. So really still remain longer term, still have the fact that I think at these areas, and I covered this in the briefing, Sam, the chap that you see in the mornings that does the briefing with me, he said that if we don't finish today below the low of yesterday, that low of yesterday is going to be the lowest point you're going to see for the rest of this year. Big call, but he's a big man. So I would say he has been right more often or not throughout this year in terms of this buying the dip mantra. And if you're looking at profitability and forward-looking outlooks for a lot of companies, they do remain very positive. Now, one thing, let's just drill this into a little bit of a shorter dated time frame and look at what's happened specifically today, because the standout move came in the Dow pre-market open. So this was around 12:30. Now, one of the things that you guys need to be absolutely aware of at the moment is we are in the midst of earnings season in the US. And today you had Boeing, which accounts for 9% of the Dow Jones Industrial Average Index. They're the heavyweight. And so with 1/10 of the index is derived from the performance of one company, and that company comes out and smashes forecasts on their corporate earnings, this is the net result in the futures market. That then coupled with the technical break that you had here on that daily pivot level meant that consequently prices shot higher, only to find some resistance then at around the resistance from yesterday's level, which would have been yesterday morning. So again, got to be aware of your corporate earnings at the moment. The market's being driven by these kind of micro fundamentals, if you like, companies' reports. After market today, you've got two bigger tech-oriented names. You've got Facebook reporting, and again, the monetizing of their subscriber base, the kind of users, new users, things like that is what analysts will be tracking and traders alike. And then you've also got Microsoft, which will be looking at areas like cloud computing, the kind of more areas of development of which most investors see the potential for renewed interest in the firm, which is going to kind of carry the balance of how investors will perceive their overall earnings report to have been. So that's the kind of equity look. So a bit of a recovery today, and so far so good, but we do have an event large obviously coming at 7 p.m. London time this evening. That's the FOMC interest rate decision. I'm going to be here and I'll cover that, give you a briefing and analysis over the event. So I'll be back online in about an hour and a half or so. So that's still potentially going to be interesting. As I said, we'll do a full rundown closer to the release, but overall I would say I'm not expecting too much. This is Janet Yellen's final meeting, but she is far too likely to just toe the party line, that she's kind of set the precedence of the communication going forward. The market is very much priced for a March hike, nothing sooner at this point. And so I'd expect her to sound relatively upbeat and optimistic about economic conditions for the US going forward, and then the fact that they remain steadfast and inflation will gradually pick up, and hence consequently they can lift rates at the next projections and press conference, which will be with Jerome Powell in March. Other things that have been interesting today, well, you've had oil inventory numbers. Now, I mean, these circles that I've got measured here was the areas of interest that I was pointing out to the guys pre the release of the inventory data, of the kind of ranges of which I'd be looking at as key technical levels in and around the release of the data, because just trying to hit the data over such a multifaceted and fairly complex release, incredibly difficult. So it's important to be picking solid outlying levels and playing it accordingly, rather than trying to jump in quick. It's typically the second, third phase of the move where often there could be the better opportunity. And what happened here was we had a fairly initial bearish reaction. Here are the numbers. You had crude almost double the size of the API number we had last night. In fact, it's the biggest build since March of 2017. We also had US output number that was up 0.42% at 9.919 million. So pretty punchy increase. So that put downside pressure on prices. However, the gasoline number was also the complete opposite of the APIs. We had a drawdown of 2 million. Last night we had a build of 2.692 million. It's the biggest draw in gasoline, so that kind of mitigated the initial downside, and that technical level worked quite well. I know one of the guys traded it from that point and righted it back up. My advice though to him was he held that trade fairly short time frame, but it was that as we got back up to the original release point was just get out. You know, at that point, the data on balance was more bearish than bullish, I would say, given the distance of margin of which the DOE crude headline was such a large build, going all the way back to nearly 10 months. And then since then, it's been a bit choppy, but net we remain where we are at the moment. Okay, going to keep this short and then just have a quick look at the calendar for tomorrow, and let you guys enjoy your evening, or I'll see you again in a few hours for the FOMC. But this is a quick look at the schedule for tomorrow's session. We have the Chinese manufacturing, this is the Caixin manufacturing PMI, it's the final reading overnight. You've then got the various other PMI readings coming out of the Eurozone. So usual sequence: Italy, France, Germany, leading into Europe at 9 o'clock. You then get the manufacturing PMI from the UK on or at 9:30. Going into the afternoon, regular Thursday activity, weekly jobless claims. In the US, you'll get your manufacturing PMI, the ISM manufacturing, probably the highlight of the afternoon. And we'll be keeping a close eye on the employment constituent here, which people will be monitoring to get a better insight and feel into how the non-farm payrolls report might come out as. Now, speaking of non-farm payrolls, let me just change this screen quickly over to ADP, because we had ADP earlier in the session, and this is often a number of which the market looks at as a fairly close correlation, or at least good insight and barometer as to the employment situation, given that it's a wide-reaching survey of multiple millions. And this figure came in considerably stronger than expected. In fact, it was above the top end of the most optimistic estimate on Wall Street. We printed at 234,000, which was pretty similar to last month, but expectations were down towards the 180 region. The revision to the prior month was minimal. So all in all, it was a pretty strong report. And actually, if you look at the dollar today, and especially after that data, you can see as I'm talking, euro dollar is moving lower. Cable's come off its initial highs on a test of R1 here in the top left. So we're getting a bit of a resurgence in the dollar. And certainly that strong data on the employment side would have helped things, given as well the fact that the dollar's been weaker in recent weeks. All right, going to leave it at that. Wish you a good evening. If not, I'll see you in the chat room at 6:45. We'll cover the FOMC live. If you're trading that, good luck.